Hello. So let's continue our discussion on ratio analysis. Last time we discussed, we stopped on the average age of inventory. So I mean operating cycle. So let's continue to accounts payable turnover. Accounts payable turnover measures how fast payables are paid. So from the time that the liability is incurred, how how fast the how fast or how many times per year that we pay our liabilities. That is what accounts payable turnover measures. So the formula is net credit purchases divided by average trade payables. So average trade payables is just simply accounts payable. So net credit purchases, like like last time, uh, like for the receivable, it is the net credit sales. So for the accounts payable, we have net credit purchases. So net credit purchases, we already deducted the corresponding discounts and the purchase returns that we incurred. So assuming that we purchased 600,000 pesos worth of merchandise, and 50,000 of those were given to us as discounts. And 50,000 is and we returned 50,000 pesos worth of merchandise because it is defective. So 600,000 purchases less the discounts of 50,000 and the purchase returns of 50,000. So we get the net credit purchase of 500,000. So assuming that the average trade payables, oh, the formula for average trade payables is beginning payables plus ending payables divided by 2. It's basically the same for every other turnover. So 500,000 divided by the average trade payables of 200,000, we have the accounts payable turnover of 2.5 times. So this turnover measures how many times we pay our liabilities in a given year. So so next we have average age of trade payables. This is how many days it will take for payables to be paid. So from the time that we incur liabilities, how many days from that time does it take for us to pay our liabilities? So we have the average age of inventory. Oh, inventory. It should be payable. This should be payable. So the average age of payables is computed as any other average age. So we just simply get 365 divided by the inventory turnover. So from our example earlier, the average age of payables is 146 days, computed as 365 divided by 2.5. So on average, it takes 146 days for accounts payable to be paid. So let's move on to the cash conversion cycle. So the cash conversion cycle is the length of time for cash used to purchase inventory to be converted back into cash. So basically, it's just the operating cycle less the average age of payables. So why do we need to subtract the average age of payables? Because it is the cash conversion cycle. It is the cycle of cash. So when we pay when we pay the our liabilities or payables, we we use cash. So we must deduct this we must deduct this average age of payables because cash is being deducted from our business. So the acceptable liquidity ratios depends on the accepted standard of the entity, but in no case should it be lower than 1. A liquidity ratio of less than 1 indicates that the entity is no longer liquid. A very high liquidity ratio may indicate that the entity might not be utilizing its assets efficiently. To avoid underutilization of assets, the entity can either choose to expand their business, establish a new project, or purchase long-term assets. So all of this liquidity ratios, there should be a balance to it. It should not be always less than 1, because if it is less than 1, it is no longer liquid. And but on the other hand, it should also not be too high, because if it is too high, it is too liquid, meaning that meaning that cash is just sitting in our business. It is not utilized efficiently. So in order to utilize our cash efficiently, we should we should either invest it, or we should expand our business. So there should in every business there should always be a balance in using our assets or cash. We should we should consider the liquidity, or we should always have enough cash, but we should consider that we don't have too much cash, that investment opportunities are being wasted. So those are the liquidity ratios. Next is the solvency ratio. For the first solvency ratio is the times interest earned. It determines the company's ability to cover its interest expense. So the formula is income before interest and tax divided by interest expense. So income before interest and tax, meaning income, we compute income, but uh, interest and tax should not be deducted yet. If a problem presents in net income after interest and tax, and it also provides interest in the amount of interest and the amount of tax, the interest and tax should be added to get the income before interest and tax. So, for example, we have income before interest and tax of 500,000, while the interest expense is 250,000. So the times interest earned is 500,000. 500,000 divided by 200,000. So it is 2 times. So the times interest earned shows if your earnings are being used to is being used up to pay interest. If a company has less than one times interest earned, then the entity's earnings are actually not enough to cover the interest of loans. If a company has low times interest earned, most operating income are used to pay interest. High times interest earning is desired. So for like this example, we have 2 times interest earned. So it means that I'm sorry, it should be 250,000 pala. So it means that from our income of 500,000, we can pay interest 2 times. That also that also converts into meaning that interest expense is 50% of our income. So the times in a low times interest earned is not is not ideal. Why? Because it means that income the amount of income that we earn is actually being used to pay interest. The from the income we retain very little amount from the income because the most of the amount we've earned from the income is actually being paid to the interest. So a high times interest earned times interest earned is desirable. So next is the debt equity ratio. So like the name suggests, it's the ratio of debt to equity. So the formula is simply dividing the total debt or total liabilities divided by the total equity. So it's debt to equity ratio. So for example, we have 300,000 total liabilities and 100,000 total equity. So the debt equity ratio is 300,000 divided by 100,000. So it is 3 times, meaning our debt is 3 times the amount of our equity. So the debt equity ratio compares the ownership of creditors to the total asset. A very First the ownership of creditors to the total asset. A very high debt equity ratio. A very high debt equity ratio shows that if the entity is liquidated, most of assets are actually used to pay liabilities, while a minimal amount goes to the owner. So like this, because uh, because we have a to equity ratio of 3, it means that when we liquidate, uh, we actually pay more to the debt, and little is being retained by the owners. So for example, the debt is 50,000. So the debt equity ratio now is 0.5. So the so because 0.5 is significantly lower than 3, it means that the owners get way more compared to the amount paid for the liabilities. So I'm sorry, but this is also wrong. That equity ratio compares the ownership of creditors to the total equity. This is not assets, equity. Sorry for all the mistakes because this learning material is actually not created by me. It was just given by my colleague. So sorry for all the mistakes. Now let's move on to the debt ratio. It indicates the percentage of total assets uh, provided by the creditors. So meaning from the total assets that the business has, what is the amount that is provided by the creditors? So the formula is total liabilities divided by total assets. For example, we have total liabilities of 300,000 and total assets of 400,000. So the debt ratio is 300,000 divided by 400,000. We have 75%, meaning that from the total assets of 400,000, 75% of these assets actually came from the creditors because the liabilities is 300,000. Next is the equity ratio. It indicates the percentage of total assets provided by the owners or stockholders. So the formula is simply total equity divided by total assets. So if the debt ratio is if the debt ratio shows the percentage of assets provided by the creditors, the equity ratio shows the percentage of assets provided by the owners or stockholders, depending on the type of business. So, for example, Equity is 100,000 and the asset is 100,000. So 100,000 divided by 400,000 is 25%. The so meaning from the total assets of 400,000, 25% of these assets actually are provided by the owners. Please take note that debt ratio plus equity ratio is always equal to 100%. For like the example, 75% plus 25% is equal to 100%, as indicated here. Equity ratio plus debt ratio is 100%. So why is it that equity ratio and debt ratio is equal to 100%? Well, it's because of the relationship of the elements or the liabilities, assets, and equity. Liabilities plus equity is equal to the assets. So, if the example provides only the total assets and the total liabilities, but the question is solved for the equity ratio, you just simply deduct the liabilities from the assets to get the total equity. For example, we have this. If the total liabilities is 300,000 and the total assets is 400,000, compute the equity ratio. So, because we don't know the total equity, but we know the total liabilities and total assets, we can compute for the total equity. So 400,000 total assets, 400,000 plus 300,000 total liabilities, we get the total equity of 100,000. So 100,000 of total equity divided by the total assets of 400,000, we have the equity ratio of 25%. Like this. Or another way of computing it is just simply getting the debt ratio. So 300,000 divided by 400,000 is 75%. Then from the debt ratio, we subtract it from 100%. So 100% less the debt ratio of 75%, we get the equity ratio of 25%. So you can compute any of this in different ways. Hmm. As long as you know the relationship among this all of this, uh, you can also get the debt equity ratio by simply dividing the debt ratio from divided to by the equity ratio. So for example, we have the problem gives us uh, givens of if the problem gives us a debt ratio of 75% and the and we have the equity ratio of 25%. So 75 divided by 25 is simply 3. So the debt equity ratio is 3. Even though we don't have the specific amount of the total liabilities and the total equity, by dividing the debt ratio and equity ratio, we get the debt equity ratio. So why is it that the dividing debt ratio by the equity ratio gets the debt equity ratio? Well, because of these formulas. By dividing the debt ratio to the equity ratio, we are simply canceling the assets, the total assets, and putting equity below total liabilities. So basically what we're doing is total liabilities divided by total assets. Total liabilities divided by total assets divided by divided by the divided by total equity divided by total assets. So with this, formula, we the total assets are crossed out because because we have two total assets on both sides. So total assets are crossed out. So what we get is total liabilities divided by total equity, which is the formula for the debt equity ratio. Total liabilities divided by total equity. So all of these are connected to one another. Debt ratio, and equity ratio. All of these are connected to one another. So please take note when a problem gives a ask if a problem requires one of these three, but you don't think that it has given enough elements, you just remember what I told you. Debt ratio divided by equity ratio is equal to debt equity ratio, and 100% debt ratio plus equity ratio is equal to 100%. So that's all for today. We will be discussing the profitability ratio next meeting. It it is the last of the ratios. So please review your handouts to get a better understanding of our lesson. Thank you and see you next time. Bye.